Okay, let's dive into this. Welcome to This Explainer. Today, we're unpacking a really eye-opening analytical report on the actual mechanics of advanced tax strategy for high-income earners. We're taking a hyper-focused structural look at a massive financial leak, one that routinely drains wealth from successful professionals, business owners, and highly compensated W-2 employees. We're going to analyze the profound difference between simply complying with tax laws and actively engineering your wealth, using direct, actionable insights extracted right from our source material. So here's a question for you. Can a perfectly accurate, error-free tax return still cost you hundreds of thousands of dollars? It sounds totally contradictory, right? We all have this implicit assumption that if our tax return is accepted by the IRS without any red flags or audits, well, we've successfully navigated the system. We assume an IRS-compliant tax return equals an optimized one. But as this analysis is going to show us, nothing could be further from the truth. In fact, filing a quote-unquote correct tax return might literally be the single most expensive mistake you're making year after year.
Here's a quick roadmap of what we're covering. We'll start with the illusion of tax compliance, then compare historical reporting to proactive strategy, and examine the absolute limits of basic tax software. After that, we'll break down the exact mechanics of this hidden cost, and finish up with the wealth paradigm shift required to finally plug that financial leak.
Let's jump right into Section 1, the illusion of tax compliance, or correct versus optimal. As your income scales up, it's incredibly common to falsely equate filing paperwork without mathematical errors to, successfully preserving your wealth. But listen, compliance is not optimization. Overpaying your taxes rarely comes from obvious errors like forgetting to carry a 1 or making a simple math mistake. Instead, it comes from unasked questions. It comes from missed structural opportunities. Because higher earners naturally assume correctness is the ultimate finish line, they end up blindly leaking wealth by not actively shaping their financial outcomes. Basically, they let their income dictate their taxes, rather than letting a strategy dictate how their income is taxed. Moving right along to Section 2, historical reporting versus proactive strategy, the paradigm shift. Now, what's really interesting about this slide is how it frames a foundational contrast. Think about the tools most people use, basic tax software, or even a standard compliance-focused tax preparer. These act essentially as algorithmic tools strictly designed for historical reporting. It's totally reactive. You input your W-2s, your 1099s, and your receipts from the past 12 months, and it simply calculates the liability on what has already happened. It is absolutely not a wealth-building tool. It's a liability calculator reacting to closed data sets. The dichotomy here is just stark. On one hand, you have tax compliance, which is reactive. It looks backward to document past choices, with the primary goal of just preventing an audit. On the other hand, tax strategy is proactive. It looks forward. It actively shapes future financial outcomes, with the specific goal of reducing your lifetime tax burden. Standard compliance simply records what happened. Advanced strategy dictates what will happen. Huge difference there. Section 3, the limits of tax software, designed for simplicity, failing complexity. When we analyze the structural differences here, look closely at that critical divergence in timing. Standard prep happens in April, which is entirely after the year has already ended. But advanced strategy, that happens year-round, specifically heavily in Q3 and Q4, long before the year closes. In terms of actions, basic software simply inputs basic deductions. Strategy, however, involves complex entity restructuring and income shifting. Because standard software is reactive by design, it inherently cannot warn you if your income structures are inefficient. There's no pop-up saying, "Hey, Ray, you're structured as the wrong type of business entity." It just flawlessly processes the inefficiency and hands you the massive bill. Section 4, mechanics of the hidden cost. Let's analyze this financial leak. Take a look at this specific number, 15.3%.
This is a vital threshold. It represents the self-employment tax rate covering Medicare and Social Security. Now, when entrepreneurs and self-employed individuals rely solely on basic filing tools, they often just operate as sole proprietors or basic LLCs. And by doing so, they needlessly absorb this massive 15.3% tax on all their net profit. Basic software processes this perfectly correctly according to the law, completely missing the crucial fact that a simple structural change could bypass a huge portion of it. And this brilliantly illustrates exactly what that invisible penalty looks like in the real world. For a business generating $150,000 in income, a basic LLC absorbs the full brunt of that self-employment tax. But that exact same income, structured strategically as an S-corporation, where the owner takes a reasonable, optimized salary and takes the rest as a distribution, avoids a lot of it. Failing to make this single entity conversion results in a completely unnecessary penalty of roughly $9,000 in a single year. You followed all the rules, your tax return is 100% accurate, and you still lost $9,000. And that entity conversion, that's just one mechanism. The analytical report details several more of these hidden costs. High earners routinely ignore cost segregation studies on real estate, which accelerate depreciation and create massive paper losses. They overlook short-term rental rules that allow active participants to use those paper losses to offset their high W-2 or 1099 income. Here is the vital takeaway we need to grasp. If you're relying on April filing, the window for executing these advanced deductions has already permanently closed. You literally cannot buy an asset or execute a cost segregation study in April for the previous tax year. It's too late. Section 5, the wealth paradigm shift, taking strategic control. Let's move to and see how this builds into a completely different timeline. Step 1 happens in Q3 or Q4. Proactive planning, actively forecasting your income. Step 2, implementing advanced entity structures, exactly like that S-Corp transition we just discussed. Step 3, executing asset strategies before December 31st, such as buying real estate and utilizing accelerated depreciation. Only after all of that is done do we reach step 4, filing the mathematically optimized return. Compare this methodical, engineered process to the single, frantic step of just handing a shoebox of receipts to a software program in April. Advanced strategy relies on multiple, concurrent levers. Financial experts don't rely on just one deduction, they combine them. They use entity structuring right alongside real estate depreciation. They combine income shifting, like setting up a management company, with fully funding tax-advantaged accounts. For instance, executing a cost segregation study on a rental property can generate enough accelerated depreciation on paper to legally wipe out 50% or sometimes even 100% of an annual tax bill for certain high-income earners. It's a real game changer. So the crucial point is right here. The goal is not to avoid taxes, but to pay what you legally owe and not a single dollar more. Strategy makes taxes a planned outcome, not a surprise expense. Treating your tax liability as a controllable, malleable variable rather than just some inevitable absolute is the true mark of financial engineering. I want to leave you with this final, provocative thought to ponder. If your income is scaled up, but your tax system is still stuck in that basic compliance phase, what invisible costs are compounding against your wealth right now? It is time to deeply analyze your structural setup and ensure your strategy is as advanced as your earning power. Thank you for joining me for this explainer. Keep learning, keep optimizing, and take proactive control of your financial future.